Well, hello and a very warm welcome to this Scope Group webinar. Cross-border M&A between European banks is best avoided. My name is Keith Mullin and it's my pleasure to be hosting the session today. And I'm absolutely delighted to be joined also by Sam Theodore, a senior Scope Group consultant. In a few moments, Sam is going to summarize his thoughts about international M&A between banks in Europe, or perhaps I should say his caveats, in an environment where transformational deals between large banks are being hyped up by interested parties and certainly also by certain regulators. At the end of his comments, Sam is going to switch into interactive mode to answer any questions you might have. And so on the right-hand side of your screen, you'll see a questions tab. So please feel free to type your questions into the screen as we go along. And as I say, once Sam's finished, we'll do our best to answer them. So that's it from me. Sam, it's really good to see you. I'm delighted to have you with us today. So let's kick off and I'll give the floor to you.
Thanks, Keith. Thanks, everybody, for showing up. I know that it's busy times with the bank results, and today was an especially busy day, but so thanks a lot for sticking around for this brief webinar. So basically, one of my most constant opinions about the European banking sector is that there's no need to contemplate cross-border M&As among large banks. As a matter of fact, the first report under the Wide Angle series, which I published for Scope in April 2019, so more than 2 years ago, was on the fact that cross-border M&As are bad ideas for European banks. If anything, at the tail end of the pandemic, I think the idea is even worse than it was 2 years ago. And I'll try to go very briefly over why I think that's the way it is. But before that, why is this idea, this concept of the need for banks to consolidate cross-border to create these pan-European giants bigger than they are now, why is this idea so active, and it's getting more active these days again? Well, I think it has a lot to do with the recent history of European banking. And I remember after the decade of restoration post the great financial crisis, when banks were again in a more decent condition, the market started again saying, fine, now that the banks are no longer about to break up or to be in resolution, maybe they should contemplate again something which was done before the crisis, which is cross-border mergers. And that didn't happen. And I thought that was a bad idea. And now with the pandemic, again, people will focus on there's another crisis. And then at the end of this actually inexisting crisis, the market is again abuzz with rumors. So are we going to see more cross-border consolidation? I remember a few months ago when CaixaBank announced its merger with the Bankia in Spain, a lot of people said this is great, but the next step now should be cross-border. So after these in-market domestic consolidations are pretty much over, let's start looking for cross-border consolidation. And who are these people actually? Well, the market participants first. You have bankers and dealers, you have traders, you have sell-side analysts, you have consultants, and not least you have financial media, and they're all rooting for juicy narratives. Why? Because the European banking industry has become rather dull, more like a quasi-utility, like a glorified utility, with the exception of some accidents like Archegos and another few names, or the occasional money laundering scandal. Nothing major is happening in the banking industry. Balance sheets are stable and quite strong. Earnings are weak, but improving vaguely, and not really being any surprise about that. So people need some changing narratives to stir up new stories, to stir up new trade flows, new deals, price movements, and of course fees for those involved in these deals. But it's not only market participants, but also some regulators which have been, and policymakers which have been pushing for this consolidation. And first and foremost, two entities, the ECB, primarily the supervision area of the ECB, and then the IMF. And the main argument, and I have them, the stated rationales for the need to supposedly merge cross-border, were number one, cost cutting and boosting profitability, which granted is very weak or insufficiently strong in many cases. Also to address the excess capacity across Europe, too many banks, too much banking supply for the demand which is shrinking, not least to help the further integration of the European single market. And of course, and that's the argument from both regulators and market participants, the criticism that most large European banks are not big enough. They are subscale compared to the US and in the future Chinese giants. So if you don't have the critical scale globally, you cannot access global deals the same way the Americans can do. And these are the main arguments why people say Europe should see more cross-border consolidation. Now, I mentioned earlier why the market seems so, some parties in the market seem so keenly interested in this cross-border consolidation. I'm not sure that when I look at credit investors and even equity investors, I'm not sure I see a lot of interest among credit investors in actually seeing more, cross-border consolidation. The banks themselves seem to be pretty cool and remarkably cool, and I totally applaud that, because really I don't see much of an economic case for these sort of mega transactions. But as far as regulators are concerned, I can also see a call it political undertone. So the ECB is the cross-border regulation supervisor for the Eurozone. So the more cross-border groups it has in its under its direct jurisdiction, like as a direct supervisor, the more powerful and the more authoritative it can be with the banks. And the more these banks can be delinked from the national governments, which supposedly would have a vested interest in making sure that the so-called national champions remain anchored to government policies. So I can understand that, but on the other hand, I can notice that, again, at the tail end of the pandemic, the message coming from the ECB is that, yes, the banking industry needs more consolidation, but not necessarily cross-border. So I think there's somewhat a moderation of the go cross-border tone, which was existing 2 years ago, 1 year ago, 3 years ago, which to me is positive, is more realistic. Now, why do I think that cross-border bank mergers is an increasingly bad idea in the post-pandemic age? Well, first of all, I see very limited synergies in such hypothetical deals. Well, assume for a bit that instead of seeing a Bankia-CaixaBank merger, an in-market merger in Spain, you saw, say, a French bank or a Dutch bank buying, say, Bankia or merging with Bankia. You'd have the same consideration to cut costs and to make the transaction more effective and more efficient and to reduce excess capacity. But that process would have more of a political undertone, because people in Spain would say, well, now that the Dutch took over this bank, it wants to send Spanish employees home. So all these aspects are much more difficult to achieve in a cross-border deal than in an in-market deal, which clearly focuses on increasing the efficiency of the banking system. That's on the one hand. On the other hand, I see little or no value in these deals in terms of as far as equity investors are concerned. Simply because if you look at the history of these transactions before the GFC, they were all troubled, especially when the crisis hit. Even the transaction, which at the time was considered very positive, that of Santander buying into UK retail banking, when they bought Abbey National and they created Santander UK. During the crisis, Santander UK had significant problems, which I'm sure Santander Spain would have been happy to avoid. Now, of course, the situation is very different, and that's an excellent integration there, or close to excellent. But I think that the experience of the pre-crisis mega transactions should make investors think twice. And actually, it made the bankers think twice and three times, and the answer so far has been no. One major drawback of such transactions would be that all these transactions take years. The post-merger, the announcement of the merger is the juiciest part. Then the hard part comes when you have to integrate institutions. It takes years. It may not be successful. In brief, it ties up senior management time, efforts, resources at a time when these people should be doing something else, i.e. focusing fully fledged on changing the culture and the infrastructure of the bank into the digital age. So if you want to look, and that's the conclusion of my, I'm not concluding yet, but the last bullet point on this slide is that if you try to consider the future, which is digital, by looking in the rearview mirror and looking at cross-border mergers of legacy, I would call them legacy banks, yesterday's business model may double, then of course maybe something is wrong there. So if you can avoid it, you should before getting into such deals. One point which I didn't mention in this slide is the fact that increasingly the risks for the banking sector are non-financial, not only financial. So you're talking about cyber risk, you're talking about misconduct risk, including money laundering. You talk about digital transformation risk, you're talking about climate change risk, environmental risk, and others. Now, when you announce a merger, you send your auditors, your loan people to do the due diligence of the other party, and they look at in the loan book. It's difficult to do that with non-financial risk and more relative and more unreliable. So I think that if you want to merge with another bank, especially cross-border, where you have little visibility, you better be sure what you're doing, because you can get uploaded with huge negative surprises. And to go back to the single market argument, I think that, and you don't need to believe in the future, you see it happening now. The single market is happening primarily in the digital space. So you have the new fintech and paytech platforms, open platforms, and that's basically the future of banking. I don't plan to spend too much time on that today, because I did it in the past, and that's a continually evolving topic. But clearly the future of banks is not to merge with other legacy banks, but to adapt and to adjust to the new digital environment, especially as more and more bank customers and bank employees during the pandemic have become more acquainted with the digital space and I don't think there's any turning back on that. So this involves not only significant investments, financial investments, which of course it's a huge proposition, but also intellectual capital. If you look at all these fintechs, which were created in recent years, the people who created them were not traditional bankers. They were IT experts with a vision, mostly millennials wearing jeans. And these people are creating the real competition for the traditional stodgy banking industry. Subsequently, some of these fintechs got on board bankers, traditional bankers, to help with the marketing, to help with the expertise, with the compliance, with everything else, a safe pair of hands, but it's not the traditional bankers which initiated all these ventures. In reverse, I don't see too much of these youngish IT experts wearing jeans or even wearing suits being part of traditional banks' top management teams or boards, which I think is negative for the banking industry. The more you have this integration between IT and banking at the highest level, not only at the operational level, the more banks will realize that you need to move away from these old 20th century business models where bigger is better in the legacy banking space to the new culture, basically, which is going to take some time to achieve. Now, there's one area where I think the argument of those who want more consolidation cross-border is true, and that's of wholesale and investment banking. Increasingly, many of these deals are global, and indeed, maybe some of the European players are subscale compared to what the JP Morgan, what Bank of America, or what another large organization, mostly in the US, rarely in China, can offer. But I don't see this, for example, if Deutsche Bank says, I want to have a bigger scale globally in investment banking, maybe the solution is not to propose a merger with BNP, just to give an example, because BNP has large retail and commercial banking operations which are not easily merged with another bank in a different country. Let's not forget that in the non-digital space, retail and commercial banking within the Eurozone remains mostly domestic. You don't have too many people in France saying, I'm going to put all my savings with or a large share of my savings with a German bank or with an Italian bank. So in wholesale and investment banking, I can see the future as being more partnerships on specific activities and segments among European players. And that's a possibility, but that's very far from a bolt-on cross-border merger between two large banks. Is there no future for cross-border acquisitions? Of course there is. And one good example is the relatively recent transaction between Crédit Agricole and Creval in Italy. Again, Crédit Agricole had a strong regional presence in Italy, and they felt an opportunity exists to build up on it, and that's a positive thing. Or if, say, in the future, Commerzbank will decide or will have to, say, sell mBank in Poland, I'm sure that another European bank with a strong presence in Poland would at least postulate, would at least be a candidate to buy that bank. So I'm not talking about this sort of transactions. I'm talking more about transformational deals. But the bottom line to all this that banks should do is that, first and foremost, the main problem they have is excess capacity, call it analog capacity. Not only too many branches, but too much capacity in obsolete back offices. Banks are moving to the cloud, but at the same time, they don't reduce physical back offices, middle offices, and front offices at the same pace. So this creates huge problems. The sooner they can do that, the better. But again, the last avenue to achieve this is through cross-border mergers between legacy banks. But these are some general thoughts. I'll leave it here, and hopefully through a dialogue with everybody, I can elaborate more. Thank you.
Good. Thank you very much for that, Sam. As Sam mentioned, please do type your questions in, and we'll be happy to have a stab at answering them. Sam, one of the things I wanted, you kind of mentioned that I wanted to perhaps bring you back to, thinking back to last year, and it was the European Central Bank supervisory arm, basically, very keen to encourage cross-border mergers. I guess the heart of what they did was they said they wouldn't impose higher capital requirements on cross-border mergers. Banks could use internal models to determine their regulatory capital requirements and use badwill to meet them. And so they were focused almost purely on capital. Why do you think that they focus so much on that specific aspect?
Well, I mean, they try to bring arguments because, I think the dialogue in the market was a lot. Why don't European banks merge cross-border? Well, because of regulatory hurdles and, ring fencing and all these things on liquidity, on capital. If only the supervisors were more open and more friendly with these mergers, maybe you could see more of that. So the ECB provided all these options, but I don't think that the main reason these transactions don't occur is these regulatory hurdles, which basically are not really essential and can be dealt with. But it's really the economics of these transactions. They really don't make any sense. Unless you create partnerships on specific activities, let's say a French and a German bank will create a partnership in investment banking. I think the ESG area is a very good opportunity, is a one-off opportunity to create such partnerships because it involves a significant investment in new structures, in new lines of business, in new clients, in a new approach to existing clients. And all these things require huge resources. Maybe they can be dealt with in concert with others, but again, not mergers. Economically they don't make sense. It's not about buffers and badwill and things like that.
No, indeed. And the other thing is, I've been, I guess, quite critical about this continuous multi-year push towards banking union and capital markets union, because the end game of that infers this evolution of truly cross-border financial services, whereas reality, as you mentioned, is that there's what people call parochialization has taken place since the global financial crisis, so that financial services takes place within national borders. Do you think, if you were sitting as head of supervision or someone senior at the ECB, would you be advocating perhaps maybe turning down or dialing down this focus on banking union?
Well, I think banking union, the first pillar of banking union has been an unmitigated success, the supervision. Obviously, the banks are now much better supervised, much more cohesively supervised. The market has much more confidence in the sector, not least due to the efficiency of the ECB as a chief supervisor. So I think the ECB has done a very good job there. The second pillar is also positive. It's more like a theoretical positive because, as far as I know, there are no banks in resolution or not about to go into resolution anytime soon. If anything, now banks are further from resolution than at any time after the crisis. But it's nice to have it there. And the third pillar right now is probably pie in the sky. I don't think that people will focus on the EDIS, European Deposit Insurance Scheme, anytime soon in very effectively. If it happens, it's nice. If not, I don't think it's a big loss. So the union in general, it's very positive. But if you have a European banking union in terms of the regulatory approach, it doesn't mean that European banks have to go in all countries and to create, supranational banking institutions. That's a different thing.
Yeah, no, it certainly is. You mentioned as well in your comments some of the fintechs and paytechs, and that there was some discussion about banks not actually merging with each other, but perhaps taking over some of these fintechs or payment providers. But it occurs to me that some of these payment providers have actually got pretty big. They're actually much bigger than a lot of the banks. Do you see that? Is there much mileage, you think, in having that sort of activity in M&A? So it's banks to non-banks or payment providers, or even reverse takeovers where payment providers actually start acquiring banks.
Yeah, there was the other day, BNP announced a deal. They're buying Floa, which is a smallish e-bank. It's not that small, but it's an e-bank in France, and they have some 2 million accounts, and that's an excellent deal as far as BNP is concerned. So these sort of deals, yeah, I can see them happening in the future more and more. I'm not sure if a large bank will be eager to buy Resolute anytime soon, but it's not impossible. I mean, a few years ago, BBVA bought Atom Bank, and they're doing business. But there's the other part of the fintechs which is much more successful than the neobanks, is the payment platforms. And here, you're right to say, well, I'm not sure that banks have enough resources to buy a successful payment platform. Take Stripe, for example, in the US, which has a huge market valuation. I think that the financial institution with the highest market valuation in the world, bigger than JP Morgan, is PayPal. So if you think of these things, you realize the payment platforms, more than the neobanks, which try to replicate the banking business model in their own way, of course, the payment platforms have a future. Could a bank buy a large payment platform? I'm not sure it's the right thing to do, because the payment platform is showcasing its independence. Take Tink, for example. Tink was a payment platform created some years ago, and which has a lot of European banks using their services. And recently it was announced that Visa will be buying Tink, which is a good transaction for both. And I think for Tink is an excellent transaction. Why? Because it's not a bank buying it, but it's one of the major credit card companies, which is a different ballgame. So it's not so clear, but what's clear to me is that the payment function, which in the past used to be the boring topic when you talk to people looking at banks, like payments. I mean, what do we care about payments? They happen anyway. Let's look at loans. Let's look at investment banking. Let's look at structured finance. Well, payments are becoming the juiciest part of financial services now, because there's a revolution in payments, both domestic and especially cross-border, and blockchain will make it even more revolutionary as it spreads its wings and technology. So I think that in a few years' time, I'm sure we'll still be talking about the BNP and the Sogen and the Santander and others, but what's behind the name is going to be quite different. And I'm not talking 2-3 years, I'm talking 5 to 10 years. What's behind the name, what's behind the brand is going to be quite different from what it is today, as much as what it is today is clearly very different from where these banks were 20 years ago.
Yeah, no, for sure. One other thing that did strike me when you talked about it was that the US banks in Europe are seen as the sort of bête noire. And in reality is, if you look at M&A advisory or equity capital market underwriting, less so syndicated lending and euro debt underwriting, but the US banks basically kind of effectively own those advisory spaces. And so it always strikes me that there's a potential kind of overreaction to the significance of the fact that, you know, the European banks don't necessarily have, you know, leading global M&A franchises. What are your thoughts about how Europe is kind of responding to this perceived threat of US banks here? And obviously M&A is also often cited as a way to create European sort of, you know, behemoths to fight this threat off.
Well, first of all, I think the U.S. banks we're talking about, like Goldman Sachs, Morgan Stanley, you know, J.P. Morgan, and the others, Bank of America, Citi, they are U.S., but they have been in Europe for decades, and they have European expertise and European people on the ground in the major financial centers as much as European banks, basically. So I think that it's not that they're lacking expertise. So they are fully competitive. They are not like a, you know, export from the U.S., recent export from the U.S. into Europe, and they're trying to mess up the market. But I totally agree with you, Keith. I think that there should be a better effort, because I think this capital markets union is coming slowly, slower than anticipated, tentatively, but it's coming. And that means a lot of bank disintermediation, a lot of M&A advisory, a lot of primary market issuance of companies which were never in the market before. So to me, if you have a very vibrant primary market activity in France, to me it's only normal that the French banks should be at the forefront of that activity. The same in Germany, the same in Italy, or the same in Spain and in other parts of Europe. Whether this is going to be happening or not, again, that's why I think there's virtue in some participative deals in Europe when it comes to big ticket transactions, without necessarily getting to mergers. There's no need for mergers, which again are costly and with a negative effect.
But yeah, absolutely. Mergers have also been put forward as a prime opportunity for banks to your point, to cut costs and to cut legacy costs. And you mentioned that some of the sort of perhaps more political aspects of doing that in a cross-border context. But if I can ask you just to generalize a little bit, it's one of those questions that it depend on each country. But as we move sort of beyond the immediate sort of pandemic scenario, do you think the kind of political, with a small p, attitude towards redundancies in banks, branch closures, and downsizing is going to be favourable towards the banks, or do you think the banks, because they've been seen as the saviors or part of the saviors of COVID, as opposed to the creators of a problem, do you think they're going to have to sort of live with these higher costs for the time being?
Well, I think it's going to be a compromise. I totally agree with you. It's, banks would love nothing but cut costs tomorrow morning. At least those people in the bank are focused on the bottom lines, but it's not going to happen because, banks, and especially now with this new ESG approach, the S in the ESG is very important. So if the bank said we're going to encourage social policies and our borrowers to have this and that, and the bank itself is being seen as ruthless, cutting just to report higher returns to shareholders, that's not going to help a lot. And I don't think banks can afford to do that, nor do they want to do that, because that's not really how the business world is wired these days. Fortunately, I would say. So yeah, I agree with that. Banks will have to be. There's a certain element of inefficiency in the banking business. The art is to get this level as low as possible without actually, throwing everything from the ship, which cannot be done, basically.
Yeah. I guess one of the things that is also a key ingredient to M&A activity is the leadership of European banks. Now, if you look around the last 18 months to 2 years, that there's been a lot of CEO changes in Europe. And you've talked in the past about, sort of management styles moving in cycles from this very aggressive kind of, hunter style CEOs to much more, perhaps after the financial crisis, towards perhaps a more staid gamekeeper type of approach. There have been a couple of CEO appointments recently of, I guess, investment bankers who've had a history of perhaps more, sort of eat what you kill sort of approach. Do you think that the cycle can change at some point, whereas CEOs, as a way to drive up the share price or to create value, start to think of M&A, or because M&A hasn't been particularly value accretive? But what are your thoughts on the sort of management styles and the leadership?
Yeah, I don't think there's in general, I think the cultural appetite is not there among the large European banks for cross-border M&As like the ones we saw before the GFC. So even you probably think about UniCredit or having a new CEO who's an ex-investment banker, but I don't think that we are on the stage where a person comes on board and says we are going to go to the old ways, or things like that. People change, people's view change, and people who get to be CEOs are supposedly very intelligent people, and being able to change is an element of intelligence, basically, in life. So I don't think that you're going to go back to cutthroat deals and to aggressiveness. And number one, number two, the public opinion, the political and social environment won't tolerate it, and last but not least, the regulators will not tolerate it. So I don't think that's in the cards for now. And again, as I mentioned earlier, I think that especially with the pandemic, large banks, have turned into glorified utilities. And you have a growing gap between what I call retail and commercial banking, which is becoming more industrial, and where actually the competition in the digital space comes from fintechs and the others, and the wholesale investment banking, which remains more traditional, and where actually we continue to see the highest risks. In a recent speech by Andrea Enria, the head supervisor of the ECB, he singled out leveraged finance as the major risk that he sees now in European banks, and he's rightly to say that. But leveraged finance is something which is mostly in the field of wholesale banking and investment banking. So again, fewer and fewer banks get into those areas of activities which are risky, which create headline risk, as we saw recently with Credit Suisse and others. So yeah, but the world is not coming back, because the digital world in parallel is moving much faster than these people who would want to bring back the banking industry.
Yeah. So what are your thoughts, Sam, about then moving perhaps away from cross-border? We have seen, not a huge amount, we've seen some, I guess, fairly noteworthy domestic consolidation attempts in Italy and Spain, and there's always this perennial talk about the fact that countries like Germany have got far too many banks, and all of which are driven by return on equity. That I'm thinking more of the public savings banks, etc. What's your feel? Do you think we'll see an acceleration of domestic consolidation if cross-border doesn't really work?
Well, it should be, but it depends, because if you take the example of public sector banks in Germany, like right now you have something like 430 Sparkassen savings banks from, I think, 2,000 or 3,000, a decade ago, something like that. Forgot the numbers. So there is consolidation, and the same for the cooperative banks, Raiffeisen and Volksbank. And so there is consolidation with each of these sectors. Also, it's not like you have in the public sector, you have and the Landesbank, and it's not like you have 430 savings banks which are independent. I mean, most of their back office functions and IT investments, they are done together. So there is a certain a combination, functional combination among all these banks, which helps them a lot. It's not like 430 independent savings banks. And for the cooperative banks, same for the Norwegian savings banks, although maybe to a lesser extent, but still there's room for consolidation among second-tier banks. Germany is atypical. You cannot really take the case of another country and say Germans could do the same, because it's a different structure of the banking system. And the same, you cannot generalize what's happening in Germany to other countries. It's really a different banking system. You say, they have a lower return on equity. Perhaps so, but people who use banking services in Germany are happy with those services. The customers, both business and retail customers, and those public sector banks and cooperative banks don't have return on equity targets or requirements, which would put them in competition with the private banks. And perhaps the business model and the structural model of this type of banking is working better than some people, including myself, expected maybe a decade or two ago. But then you had those dreadful Landesbanken, which are now pretty much cleaned up, more or less, and merged. Even now, I see actually in the US, there are some efforts in some of the US states like California or Oregon to recreate some networks of public sector banks to help financial inclusion, because let's not forget 25% of households in the US don't have access to a bank account or are underbanked. They don't have access to a lot of banking services, which is clearly not happening in Europe.
Yeah. No, indeed. Thanks. Sam, there are no more questions coming up. So unless you have anything else to add, we should perhaps move to conclude. And so feel free to make some final comments, but otherwise, those of you still logged in, if you could click on the button that's just appeared and literally spend 30 seconds filling in a quick feedback form, it's quite helpful to us just to figure out what it is that you and the market need, and it helps us sort of sculpt our offering to you. So please do click and fill that in. That'll be very helpful. And so, Sam, thank you so much for your comments, and I hope there weren't too many curveball questions there, but I think you answered them in your usual stellar fashion. So thanks for that. I think that maybe post-summer, we'll come back with more of these events. I think that depending on what you tell us you want, then we'll create events to suit. So thank you very much to those of you dialed in and stayed till the bitter end. I know it's been a busy month, and we still have a few more bank results to come out, Q2. So I guess next week we got some of the laggards coming through. So we'll be back for more at some point soon. We'll be back in touch. Look out for any other events that we're hosting, and please do log on. We'd be delighted to see you again. So Sam, enjoy the rest of your summer, and thanks a lot. And we'll see you all again next time. Thanks and goodbye from us.